Welcome back to Economic Outlook. After our series of discussions on fuel hedging in the airline industry, I received a request to discuss commodities in more detail, so that's what we'll do in our next series of entries. First, we'll look at how commodities markets have developed over time. Next, we'll look at the recent capital inflows into commodities and see how this has affected prices. Finally, we'll examine speculation, specifically with the oil industry, and try to determine whether or not it's had a tangible effect on oil prices. To understand how modern commodities markets function, we need to see how they've developed through time. Ever since people began engaging in commerce with one another, they've needed a way to standardize contracts for the delivery of goods at a future date. We saw the first examples of this in the 3rd century BC in ancient Sumeria. Sumerian farmers traded sheep and goats with various dealers. Eventually, these farmers began to pledge a certain quantity of goats or sheep to dealers at a later date. To represent this quantity, the farmers would use small clay tokens that were baked in the shape of the animal they were going to deliver. These tokens were a form of commodity money. When the farmer would deliver his livestock to the dealer would break open the jar and count the tokens inside to make sure that it matched with what the farmer brought for delivery. This way he could make sure the farmer lived up to his end of the contract. These early forms of commodity money weren't backed by large state banks. Instead, local banks and moneylenders would vouch for the reputation of the farmer entering into the contract. However, over time, these contracts grew more numerous, and eventually, classical civilizations were able to expand into global trade using gold and silver to acquire a variety of items. Ultimately, states that were able to back and clear transactions of this type were able to grow their economic power. Modern commodity trading actually has a lot in common with what the ancient Sumerians began to develop nearly 5,000 years ago. We can trace the roots of modern trading to Chicago in the 1840s. Chicago was becoming a large commercial center with rail connections to both the East Coast and West Coast. Telegraph technology made it possible to communicate with these major population centers. When the McCormick Reaper was invented, the Midwest saw an explosion in wheat production, and Chicago was a logical destination for farmers to come to sell their wheat for distribution across the United States. As more farmers came to Chicago, several problems emerged. First, the city lacked adequate warehouses to handle all the grain farmers brought with them. Second, when farmers did bring grain, there were no standards for weighing and measuring the types of grain farmers brought. That means that prices varied wildly between different dealers, and farmers had to shop around to find the best price to sell. Chicago tried to rectify this by setting up the Chicago Board of Trade in 1848. This was a centralized location for farmers and dealers to meet and negotiate prices for grain. This allowed farmers to bring grain and sell it to dealers in a central place at a certain spot price. The spot market allowed for the creation of the modern futures contract. Eventually, farmers and dealers began to commit to exchanges of grain at later dates at prices agreed upon today. This allowed farmers to know how much they'd be paid for their crops and let dealers set their prices in advance. These contracts were eventually written, and sometimes even a small guarantee of money would change hands to secure the value of the contract. Eventually, these contracts became standardized at the Chicago Board of Trade. Once they were securitized, they could be used as collateral for bank loans. In addition, farmers and dealers could sell contracts before their expiration dates. For example, if a farmer couldn't provide the wheat he promised in his contract, he could sell the contract to another farmer who could provide the wheat. Additionally, if a dealer didn't want to take delivery of the wheat, he could sell the contract to someone who did. Once contracts began to be exchanged, their values began to fluctuate depending on events in the market. Let's look at an example of how market events might affect the value of an early futures contract. In this case, we have a contract for 5,000 bushels of wheat priced at $1.50 per bushel. That means the value at inception was $7,500. Let's look at what happens under two scenarios. First, if there's bad weather and less wheat on the market, the price would increase. If the new price were $2.50 a bushel, the value of the contract would increase to $12,500. That's a difference of $5,000 because of the price of wheat. Now in scenario 2, the opposite happens. There's an unusually large harvest, so the price decreases to $1 per bushel. That means the value of the contract is only worth $5,000. In the first scenario, the holder of the contract has really made about $5,000 in profit. The farmer sold his wheat for less than the spot price on the delivery date. However, in the second scenario, the farmer was protected from the drop in price, and the dealer actually lost money, because he has to pay more than the spot price at delivery. As you can see from this example, the purpose of futures contracts was to protect both farmers and dealers from fluctuations in price. Eventually, people who had no intention of taking possession of wheat began to buy and sell futures contracts in hopes of making a profit off of these swings in value. These were the first speculators in the commodities market.